option will begin generating profits, while the put option will incur losses. At this point, there should be a specific time or price level where we decide to exit the put option and hold onto the call option to maximize gains. This approach ensures we adapt to market movements effectively and capitalize on the profitable leg of the strategy while minimizing losses on the other side.
Okay. But you are why will you do that? You will do this when you expect, you don't know which direction it will go, but you think that the market will be more uncertain than the option price which you are paying. So when you are paying option price, when you are buying an option, there is something called the implied volatility. So there is a volatility which is already built into the option prices. Okay. So there could be option prices go up or down depending on the high volatile market or low volatile market. So you are already paying for the volatility. But if your view is correct that the coming months are more volatile than what you expected or what people are expecting, then you will benefit. Otherwise, your money will be slowly get wasted.
Yes.
And whether to exit or not, that's a very, very different calculation, because that depends on how fast the movement happens. Like today you buy, whether within 2 days the volatility happened, right? Or how much movement it happens. If it happens within 2 days, significantly more volatility, if you exit, you'll get some gain. Because you bought an option today, long vols, and the market suddenly started moving, you can exit. That exit decision is something which is dependent on the mark to market. I'm just explaining the basic payoffs right now. So these are the next two strategies. One is a long straddle. Long straddle, I just explained that this is a very common strategy. This is a strategy completely a view on volatility. It is not a view on direction. See, you can see very clearly it is direction independent. Both sides, 1245 maximum loss, 1255 gain. It's not maximum gain. You can gain more if market moves further, but you will gain only if there is a sharp movement on either side. So what you are basically betting is that the next 2 months is going to be very volatile, more volatile than what the market experts or the traders are thinking as of now. Then this will make sense for you. Okay. However, if you're on the other side, you think that market is actually not going to be too volatile, but at the end of next 2 months, market will be here only. There are some factors which will take it down, there are some factors which will take it up, but overall market will be here only. Then you'll do exactly the opposite. You'll short straddle. Little risky strategy, but a very, very common strategy in the market. What you do here is you sell a call and sell a put, and day one you collect the premium from the market. Very, very common strategy this is. Okay. This is a play where market is